the takeaway is this. When you have a fair value gap and you have small little cracks in the delivery price, like that little tiny volume imbalance right there, this tells you where the wick can go, but how can you trust the trade is still viable? Or if you miss this first run up here, can you trade it if it goes into it again in here? Yes. That's a reclaimed fair value gap. That's the fact that the market's offering that again, it's reclaiming that fair value gap. But the wicks are doing the damage. So how can it run against you? How far can it run against you, rather? Well, it can trade into that volume imbalance. But if it does both and it starts to slam down, you really are being like a billboard sign, like on an interstate saying you're running low on gas, or if you're hungry, pull out on this exit here because we have the goods. It's a good thing to come this direction. Well, that's kind of like a neon sign saying that the bodies are staying inside this fair value gap. These are all things that you're going to annotate while you're watching price. Look where the bodies are. You see that? What's the wick doing? The damage. To what? To what degree is that wick going up against the underlying expectation? If you're going to trade with this pattern, what is the extreme of how far that wick can go? Well, look back over here. We have this short-term high. Does it go above that? Sure it does. But how high can it go above that, ICT? Look to the left. What do you have left? Volume imbalance. Deliver, one tick above, back down in. Consequent encroachment. Consequent encroachment. Fails to get to the consequent encroachment. That's what you're looking for. You want to see the next candle start to dive, go lower. Does it? Oh, wow. Now you can use this as an institutional order flow entry drill. Trades up into that gap, but you want to see that left open. You don't want to see that fill in, because if it can leave that open, guess what that means? It's a breakaway gap, and it's probably going to remain heavy. And it may afford you 15, 20, or more handles. Something to that effect. And you're weighing out all of these potential delivery mechanisms. Your stop loss would be here. Here's your fair value gap. Institutional order flow entry drill there. It spikes up, yes, but beforehand it trades down to the low of the new day opening gap on Tuesday. You would take a partial here. If you were holding on for more, chances are you probably would have got stopped out because you would have definitely been moving your stop loss below the fair value gap. But you're paid.